Hello, I'm Carl Turner, and in this video, I'll explain what kind of pensions are taxed if they are remitted into Thailand and which types of pensions aren't. I'll also explain who needs to file a Thai tax return and who doesn't need to file. So we'll learn this within 3 to 5 minutes. With the recent changes to the Thai tax rules for foreign sourced income that's remitted to Thailand. So what does that mean? It means if you have overseas income and you remit, transfer into Thailand and you stay 180 days or more in a calendar year. From 2024, now you have to file a Thai tax return if you are over the minimum thresholds. So what I will do in this video is explain what are the minimum thresholds, which pensions aren't taxable, which ones are taxable, who needs to file and who doesn't. So the key point to remember is not everyone has to file a Thai tax return. So you have to meet certain criteria. So the first criteria is you have Thai domestic income. So what does this mean? It means if you have Thai rental property or you have a local Thai salary, then you have to file a Thai tax return. Also, if you stay in Thailand 180 days or more and you remit, so transfer in foreign source income. So this means things like overseas pensions, investment capital gains, rental property income, sell a property overseas and remit the funds into Thailand. If you have dividends or a salary overseas, you stay in Thailand 180 days or more and you transfer that money into Thailand, then that is classed as assessable income. So today we'll focus on pensions specifically. So if you are, let's assume that you're a Thai tax resident, so 180 days in a calendar year. So 1st of January to 31st of December. If you're in Thailand 180 days in that time period, you're a Thai tax resident. This doesn't mean that you have to file a Thai tax return. It just means that if you do have foreign sourced income that's remitted to Thailand, potentially you do have to file. So regarding pensions, if you have a pension that's paid overseas, and you bring that pension to Thailand while you are a Thai tax resident, so 180 days or more in a calendar year, then if you are over the minimum thresholds, you need to file that on a Thai tax return. So what are these minimum thresholds? They're quite low. If you are married and you're filing jointly, so your spouse doesn't have an income, then if the amount that you bring in is over 220,000 Thai baht per year, then you have to file a Thai tax return, regardless if you have higher allowances, tax to pay or not. And if you are filing singly, so your spouse has an income or you're not married, then you can only bring in 120,000 Thai baht from pension income from overseas to not have to file. So let's assume that you meet the criteria to file, so you meet those minimum thresholds. Then what you have to do is then look at the specific pension that you are remitting to Thailand, because they're not all equal. We have to look at the Double Taxation Agreement. So they're called DTAs. There are 61 double taxation agreements between Thailand and other countries. We have to see what it says in that double taxation agreement for specific assets, so your specific pension. So there are some that are typically excluded. These are civil service pensions, military pensions, and some other typical ones that are excluded from having to file and pay tax in Thailand are US Social Security pensions and Canadian pensions. They're excluded in the Double Taxation Agreement. Let's assume it's not one of these pensions and you remit in your pension into Thailand, then we have to file for the amount that you've remitted into Thailand in that tax year. So if you bring in 500,000 Thai baht or 1 million Thai baht or 10 million Thai baht, it doesn't matter on the figure. As long as it's over that minimum threshold to file, you have to file a Thai tax return. That's irrelevant whether you've paid tax in another jurisdiction or not. So let's talk about that in detail. So a lot of people say, well, I've paid tax in the other jurisdiction. Why should I have to file, or I don't need to file? The Double Taxation Agreement doesn't mean that you don't have to file a Thai tax return. It may mean you may be able to claim tax credits against the tax owed in Thailand, but it doesn't mean that you don't have to file. So let's assume you do stay in Thailand 180 days or more, and you remit, transfer in, or spend on an ATM that's got your pension income on there in Thailand. Then you need to file a Thai tax return. For 2024, you need to file by 2025, the 31st of March. So you file the following year in the first 3 months. If you do need to file a Thai tax return, then what you need to do is you need a tax ID number. So you can obtain a Thai tax ID number by visiting your local revenue department and revenue office. And if you provide the correct information and documentation, they can provide you with a 13-digit number. Or you can use a paid service like Expat Tax Thailand, where we can obtain that for people on their behalf so they don't have to visit a government department. Once you have a Thai tax ID number, then you need to submit your tax return before March the 31st, or if you're filing online, before the 8th of April. And on the tax return, you need to file all of the foreign sourced income that you've remitted to Thailand and or any domestic income as well. So that's what's needed to be done. The problem with this now is on visa renewals, it's expected that immigration may start to ask if people have a tax certificate or proof that they don't need to file a Thai tax return. It's important that people comply, even if they've got a small pension and they don't have tax to pay. If they don't file and they have an obligation to, they can be fined 2,000 Thai baht, and it can cause an issue with visa renewals as well. So for pensions, it's quite simple. If you do remit in foreign sourced income and it's pension income and it's not excluded on the Double Taxation Agreement, it needs to be filed on a Thai tax return. Then we need to look at the specific Double Taxation Agreement between that country and Thailand to see, can we offset any tax paid in another jurisdiction with the tax owed in Thailand? Can we use a tax credit, or do we have to pay the tax in Thailand? That's the sort of work we help with at Expat Tax Thailand. We have a tax filing service called Essential Tax Filing. If you don't need to claim tax credits, it's very simple. It's 8,000 Thai baht. We can do everything online with our online client portal. If you do need to claim tax credits and you need to file a tax return, but you've paid tax in another jurisdiction, we have a service for that. That's called assisted tax filing, and that's 14,000 Thai baht. And if you'd got a more difficult case, or you'd like help and support throughout the process, we have a different filing service called Expert Tax Filing, where we can help you through the full process. If you'd like more information about whether you need to file a Thai tax return for your pension income, feel free to book in a free consultation on our website, expattaxthailand.com, or you can look at our frequently asked questions section that's got over 300 questions that have been answered on there. We also have a weekly Q&A webinar that might be worthwhile joining as well, so that you can ask your questions live.